Arun Kaul joins us, Chairman and Managing Director of UCO Bank. Arun, it's a bad timing. Bond yields have gone to about 9.4. Rupee has plunged to a new historic low. First, just for the benefit of our viewers, can you outline the bond hit on UCO Bank's balance sheet because of what's happened to bond yields in the last 4 or 5 days?
You see, the estimates which have been made, no bank will make it public because it's all price-sensitive information. But approximately the entire banking industry is suffering a loss of between 40,000 crore to 60,000 crore rupees.
So, Arun, as a banker, would you also be looking at revising your deposit rates given the way the bond markets have been shaping up?
You see, banks' deposit comprise of short-term deposit, medium and long-term deposits. What you have seen right now, the shorter end has really risen very high. So all those banks that only depend on the short-term deposits will have the cost of deposits move up. They may have no option but to pass on the burden to the consumers. Banks which have more of the long-term resources and the medium-term resources may not get immediately hit because of the increase in the shorter end of the yield curve. So for the UCO Bank is concerned, our dependence on short-term deposit is very, very small. We are examining whether the cost of fund has moved up or not. There will be a very small increase if it would be there. But I'm saying banks will increase their lending rates only when the cost of deposit moves up.
M. Narendra from IOB as well joins in on the show. Mr. Narendra, hi, morning. With bond yields now almost nudging 9.5%, what's the extent of hit that you think you may take on your treasury book?
Currently, nobody can exactly presume what is the impact on the treasury, but there is definitely an impact on the treasury. But I always believe that these are all evolving and it is only a dynamic proposition. And this type of situation in the market is not going to remain for too long a period. And we have to see always in a horizon of at least a quarter. And we have a long time up to September. And as an active player in the market and the bank which has a good share of the bond market, we may have certain mark-to-market. But I am sure there will be some solution to that, and all of us also have asked Reserve Bank of India also to look at that, so that because they are not, and even then of course it is a notional loss, that we have to take a note of that.
Right. So Mr. Narendra, as percentage of your total investment book, how much is currently in the AFS and how much is there in the long duration?
See, it is because duration is again a continuous process. Today's duration may not necessarily tomorrow. And I am a player, I have to continuously in the market. Today, of course, the volume has come down. So, but I am not an outliner having a very large duration. Of course, our overall duration may be, as per the HTM and all together, maybe around 5.35 like that. But as far as the AFS, it is in the equivalence because it is difficult for a bank like us to get prior fixation as to the duration immediately, but we have internal limits to that. But as far as the depreciation, today everybody is speculating each bank's depreciation, so we have to wait up to September. And I am sure, because it is very ideal that we definitely look to our regulator to give us some solution, and at that time it can be factored.
So, Mr. Narendra, for every one movement in bond yield, what is the hit that you would take on your treasury book?
See, now 1%, because what because it is currently, suppose I may also sell also. If I have some where it has a lesser loss, I may sell also. So to say that currently to arrive at the exact figure, but for our bank of size and our portfolio, we do have depreciation, but now in terms of the market share, we may not be the larger market share in that. So we will, in line with the 10-year moving like abnormally like what we've seen today, we will have a depreciation. But I have not looked at exactly calculation of that, because I still believe from my angle that we are finding a solution to that.
Arun, for UCO Bank, what are the numbers? How much of your current treasury book is allocated in AFS and how much is there already locked in long-term duration?
You see, my AFS should be approximately 27-28%, and majority of the AFS, the duration is much lower because we have built up a huge portfolio of treasury bills and CDs. So I don't think my portfolio is, duration is very large in the portfolio. Therefore, whatever MTM loss is there is quite manageable because we stopped purchasing government securities quite some time. A couple of months back, we totally stopped purchasing. The yields went down. So we are relatively better placed today. However, there is MTM loss in the books, undoubtedly, because whatever we purchased the last 5 years is suffering a depreciation loss today. But it is manageable. It's not very large.
So for every 1% movement in the bond yield, what is the kind of hit that you're taking on your treasury book?
See, my duration should be approximately 2.5 because a very large T-bill portfolio.
Are markets then overestimating the MTM losses for PSU banks?
You see, whatever information is there in the market, please try to understand that all securities purchased the last 5 years are suffering MTM losses. The yield has come so high. So whatever has been purchased the last 5 years, whatever is in AFS book is suffering MTM losses. There's no doubt about this.
Do you think the spike in bond yields is temporary, or it could now bond yields eventually will settle above 9.1 or 9.2?
You see, in the past, whenever there was pressure on the currency, we have seen shorten the yield curve moving up, we have seen liquidity going out, we have seen spike in the yields. If you look at 1998 or 2000 when the Southeast Asian crisis came up or the dot-com bubble burst was there, the yields went up and the supply side was stopped. You know, RBI took private placement or things like that. What you recently noticed, because of FRBM consideration, RBI is not able to take any private placement. So the GSEC supply continues in the market, and that is putting more pressure on the yields. If you look at the last week's auction, 10-year cutoff was somewhere around 9.74 or something like that, 7.2 or 7.4, and today the 10-year YTM is 9.46. And again, another auction is lined up next week. So continuous supply of GSEC is also hurting the market sentiment in a very big way.
Arun, I guess the big fear with the bond market players is that bond yields have gone up and Reserve Bank of India has not moved. And now it's a matter of time Reserve Bank of India could move. So if Reserve Bank of India, when they move and if they announce a repo rate hike, that really will inject more panic in the bond market.
No, I'm not sure if repo rate hike is going to serve any purpose right now. You know, objective under these conditions is to curtail speculative pressure in the currency. RBI moves have ensured the liquidity is sucked out. RBI measures have ensured the shortened the yield curve is moved up. RBI measures have ensured there's no speculative pressure in the currency. Under these conditions, I'm not sure if raising repo rate is going to serve any purpose at all right now. But yes, if they raise, it would be pretty bad for the bond market.
Arun, bankers had earlier requested RBI to allow one-time shift from AFS to HTM as well to protect the losses in the treasury book. Do you think the RBI is going to allow this anytime soon?
This is a demand made by the bankers to RBI because there will be a fairly large hit on the bank's portfolio otherwise. Let's wait and see what RBI does.
Arun, so do you think eventually all banks, they need to be capitalized? Because if you report MTM losses, your tier 1 capital will get impacted. The NPA situation in the system per se is bad. NPA situation is not likely to improve in the short term. So do you think it's a matter of time Government of India will have to recapitalize all the banks in order to, so that they can maintain the tier 1 capital?
You see, such measures which have been taken in the past for correcting the external value of the currency have been short-lived. They are not very long-term measures. So we have a view that this condition may not prevail for a very long time. We'll have to wait and see. In the past, such measures have generally lasted about 4 to 6 weeks. Already we have seen about a month for these measures continuing. Let's wait and see what happens. At some stage the rupee stabilizes, they'll have to start rolling back these measures. If they do not roll back, if this condition continues, yes, bank would certainly need additional capital.
Arun, the Reserve Bank has been completely absent while the rupee has slid from 62 to now testing 64 as we speak. What is your own estimate on how much more weakness could we see in the currency?
You see, it's difficult to speculate on the currency part because it would depend upon our current account deficit, our trade balances, our remittances, flows. There are a lot of factors that influence the movement of the currency. It will be very difficult to speculate. But the fact is, today and yesterday there was sort of panic in the market. We see the fairly sharp drop in the external value of the rupee, which is not good for the market. I
don't know. What is your understanding of credit demand? Do you think the impact of rupee the fall in rupee could also impact credit demand, or credit demand or rupee movement, they've got no correlation?
No, we have seen not many new projects coming up. So demand from the new projects is not very large. In the last 2 months, we certainly saw some demand coming up from the sector which used to traditionally borrow from the CP market, the bond market. They have started demanding some money because that market access to the market is not available to them, or they're very expensive. With rupee depreciation, there's a possibility some of the players might shift from the foreign currency borrowing to rupee borrowing. That possibility cannot be ruled out. We've seen in the past also that happening. That demand could come up.
Narendra, I want to take final comments from you with interest rates now staying at elevated levels since July. Will you as a banker take a call on hiking deposit rates as well as base rates?
See, recently, when we thought prior to this action with the Reserve Bank that it is high time that we were planning that the Reserve Bank will have more space to provide some interest rate reduction or the reference rate reduction. So we reduced our deposit rate by 20 basis point, that is 1 year ago, from 9 to 8.80, which recently again we increased to 9. So all our deposit rate 1, 2 years, 3 years, 5 years currently remain at 9%. Then as far as the certain bulk deposit rates, that means which are accepted over the card rate, we had to respond depending upon the volume and the need for funds. Here in this segment, recent days there have been a little spurt in the short-term rates, and the rates have gone slightly higher. However, depending upon our need to look at the current credit demand, I find that we need not be aggressive in that deposit rate. So we only to the extent of our immediate requirement or our relationship, some such higher rates we offer for bulk deposit. So to say that today to increase the deposit rate, the ALCO every 15 days we discuss. So suppose this is likely that this for some time, because you are also now going for a busy season. By that time these things should be sorted out. But if we find that there is a need, then the retail deposit rate, looking at that slightly improvement, we may look at.
Okay, Narendra as well as Arun, good to have you guys on board with us, and thanks for chatting so candidly about the currency markets.